Okay, welcome to Chapter 4, Product Definition. Why are there so many mutual funds? Okay, well, they all have different investment objectives, okay? Well, they can have all different investment objectives. Some seek income, some seek capital appreciation, preservation, or a combination of these. They could, have a wide variety of different investment objectives. One objective could be, we're going to try to make you money, I'm simplifying this, in the emerging markets. Now here's the catch. What's the difference between investment philosophy and investment objective? Different managers can have the same idea, can have different ideas for the same objective. So the way I try to make money for you in the emerging markets, Brazil, Russia, India, China, could be different than, let's say, how another manager is trying to make money in that market. But we still have the same objective, to make you money in the emerging market. You'll notice a lot of investment objectives in your prospectuses that I've asked you to look into. Will have similar investment objectives. They're broad on purpose. The managers obviously are going to like a lot of leeway in terms of how they can manage their funds. Okay, the profit to be made in this business has brought many players into the market, right? Defining a fund. A fund will explicitly define its investment objective, as well as how it will operate in pursuit of that objective. It must file a Form N1A, which comprises of 3 parts. The prospectus, the most important part, the statement of additional information, and any other information provided to the SEC. You should know what a prospectus is. Needs to be delivered to anyone who is interested in the fund. The book has a complicated explanation of this. It says, a company can ask for it, a person can ask for it, an investor can ask for it. Basically, anyone who wants prospectus can get one. Okay? Now, because of the internet, they're all available online at little or no cost, or at really no cost to anyone. There is an industry push to have simpler language in the prospectus. Why? Because if a lawyer writes the prospectus, it defeats the purpose of having one, because if you can't understand it, why have one? The prospectus includes cover pages, risk return summary, fee table, investment objectives, principal strategy along with related risks, management and organizational and capital structure, and yada yada yada. You guys can read the rest of this slide. Okay. Statement and additional information features a little bit more information, fund history, further description of the fund, the management of the fund, the control persons, the portfolio managers, the names. This is interesting. There are, like there's superstar baseball players, there are superstar portfolio managers, and on face value, you might not be able to tell when it's a change in portfolio manager. I remember one of my friends telling me about a mutual fund, being like, "Oh, Mike, sell this mutual fund and buy this one because this portfolio manager left that company and went to a new company, and he's the reason why the fund has done so well." That information can be found in the portfolio statement of additional information. A lot of other information here as well, including financial statements. Okay. Other information becomes part of public record but is not normally distributed to investors. This can include articles of incorporation, detailed information about personnel, and location of fund accounts and records. Why would you even want this? Who knows? But if you want it, you can ask for it and they'll give it to you. Okay? Categories of funds. There's bonds, stocks, both. There's funds that include looking to get capital growth, income, preservation. Important topic to bring up. When you're looking for growth, what age range are you typically in? Well, you're probably going to be in your 20s to 40s. You're looking for growth. You're looking for income and preservation. You're probably, income is probably, post-retirement. Preservation is probably close to your death, right? Morbid topic, but hey, right? Or maybe not consider preservation at all. You don't want to leave any money to anybody. Spend it all, right? Does the fund use quantitative or fundamental analysis? What is the difference between quantitative and fundamental analysis? You should know this, okay? Fundamental analysis is more involved with, the personal touch. Like, I talked to the manager, the CEO of this company. I talked to the manager of this company. I went to their manufacturing plant. I saw how everything works and how efficient they are. I looked at their financial statements. Quantitative management, on the other hand, is more computer-driven. analyzing ratios, and the ratios, how they interact with each other, and different factors. And the computers make most of the decisions. Okay. Another category of fund, corporate debt or government securities. Okay. A little information here. I probably won't quiz you on this. Morningstar, they rate mutual funds. They categorize them into the 4 basic groups: domestic stock, international stock, fixed income, taxable, and tax-free municipal bonds. They have 34 different categories for equities and 11 different sectors and 14 different categories of international stock funds. The rating agencies have come under fire for their practices after they universally missed the financial crisis that started in 2007. A lot of these funds had AAA ratings, and guess what? They really weren't AAA. Approaches to investment decision making: active versus passive management. Active management, you're going to pay higher fees because the portfolio manager is supposedly trying to use his research and skill along with the rest of his team to make you a better return than the market. What do we mean by the market? You're trying to beat the benchmark. You're trying to compare your portfolio versus, let's say, the S&P 500. Okay? Top-down versus bottom-up portfolio construction. Top-down, we're going to look at first the economy overall, then certain countries, then the industries, then the sectors, or vice versa, and then the individual companies. Bottom up, it's just that in reverse, okay? Growth versus value, okay? Growth companies are typically companies that are what? Growing, not paying dividends, okay? Value stocks are going to be companies that, based on certain metrics, different benchmarks define them differently, but, maybe stocks that pay dividends, right? Fundamental versus technical analysis. That's kind of like the similar approach versus fundamental versus quantitative analysis. Technical analysis has to do with, moving averages, momentum in the stock, things that would almost seem irrelevant in terms of how good or bad a company is. But sometimes the price of a stock isn't rational. Sometimes it goes up because psychological factors like, it won't drop below $10 because, for a variety of reasons, psychological reasons. There's market timing, asset allocation, group rotation. When the economy is doing good, we might have a mutual fund that does group rotation. That might be our investment strategy. And we might say, all right, when the economy is doing great, we're going to invest in energy. When it's doing bad, we're going to invest in groceries, stocks, momentum investing, that's technical analysis. And that's it for Chapter 4. Quick chapter here. Make sure you do the reading. I only cover a certain amount of stuff here in these slides. It's very important you do the reading. I try to keep my quizzes only based on what we're covering in the slides, but anything in the reading is game.